What's up everybody, it's Graham Stephan, and I'm really excited to be ghostwriting this script for Sushi today because we're diving deep into a topic that's close to my heart-busting investment myths. Look, the world of investing is full of misinformation. It's like a jungle out there, and if you're not careful, you'll get eaten alive by these common investing myths. That's why I'm here to arm you with the truth. We're going to expose these myths, break them down, and give you the knowledge you need to make smart decisions with your money. So buckle up, hit that subscribe button, and let's get started. Now you've probably heard the saying, don't put all your eggs in one basket. That's Diversification 101, right? Well, not so fast. A lot of people think diversification just means spreading your money across different asset classes like stocks, bonds, and real estate, but that's only part of the picture. True diversification goes much deeper than that. It's about diversifying within asset classes, across industries, and even geographically. Think about it this way. If you own 10 different tech stocks, are you truly diversified? Not really. If the tech sector takes a hit, your entire portfolio is going to feel the pain. To build a truly diversified portfolio, you need to think outside the box. Look beyond just stocks and bonds. Consider alternative investments like real estate, precious metals, or even collectibles. Within each asset class, diversify across industries. Don't just invest in tech. Look at healthcare, energy, consumer goods, and other sectors. And don't forget about geographic diversification. The US stock market isn't the only game in town. Consider investing in international markets to reduce your exposure to any one country's economy. Remember, true diversification is about spreading your risk strategically. So if one area of your portfolio takes a hit, the others can help cushion the blow. We've all seen those flashy ads, promising guaranteed returns based on past performance. They make it sound so easy, right? Just invest in this hot stock that's been skyrocketing, and you're guaranteed to make a killing. But here's the harsh reality. Past performance is not an indicator of future results. It's like driving a car while only looking in the rearview mirror. You might be on a smooth road now, but there could be a massive pothole right around the corner. The market is constantly changing. What worked yesterday might not work tomorrow. New technologies emerge, economic conditions shift, and investor sentiment can turn on a dime. Relying solely on past performance is like trying to predict the future by reading tea leaves. It's just not a reliable strategy. Instead of chasing past returns, focus on what truly matters. A company's fundamentals, its management team, its competitive advantage, and its long-term growth potential. Do your research, understand the businesses you're investing in, and don't be afraid to ask questions. Remember, investing is a marathon, not a sprint. Don't get caught up in the hype of short-term market fluctuations. Tune out the noise, stay focused on your long-term goals, and make informed decisions based on solid research and analysis. Timing the market beats timing the market. It sounds good, right? But it's not that simple. The idea of buying low and selling high is tempting. But consistently timing the market is incredibly difficult. Focus on what you can control. Develop a solid investment strategy based on your goals. Now, this doesn't mean you should just throw your money into the market blindly and hope for the best. A strategic investment plan is crucial, and that often means being proactive. Remember 2008? People who ignored the warning signs and just kept telling themselves long-term ended up losing a fortune. A well-defined strategy involves things like dollar-cost averaging, where you consistently invest a fixed amount at regular intervals, regardless of market fluctuations. This helps you average out the cost of your investments over time and reduces the impact of market volatility. It also means understanding your own risk tolerance. Are you comfortable with the ups and downs of the stock market, or do you prefer more stable investments? Your investment portfolio should reflect your individual comfort level with risk. Remember, investing isn't a one-size-fits-all endeavor. It's about finding the right balance between risk and reward for your specific financial situation. So ditch the idea of trying to time the market and focus on building a strategic plan that will help you achieve your financial goals. Bonds. They're often touted as the safe investment, the reliable alternative to the volatility of the stock market. But not all bonds are created equal. Some can be downright risky. Essentially, when you buy a bond, you're lending money to a government or corporation. In return, they promise to pay you back the principal amount plus interest. Bonds come in different flavors: government, corporate, municipal. Each type carries its own level of risk. U.S. Treasury bonds are among the safest. Junk bonds, however, carry a much higher risk of default. They may offer higher interest rates but can result in significant losses. Remember, even the seemingly safest bonds aren't entirely risk-free. One major risk to consider is interest rate risk. When interest rates rise, the value of existing bonds tends to fall. Why? Because investors can now buy new bonds with higher interest rates, making your older, lower-yielding bonds less attractive. Then there's inflation risk. Inflation erodes the purchasing power of your money over time. If the interest rate on your bond is lower than the rate of inflation, you're actually losing money in real terms. And let's not forget about credit risk, which is the risk that the issuer of the bond will default on their debt. This is particularly relevant for corporate bonds, as companies can face financial difficulties that may lead to default. The key takeaway here is that blindly investing in bonds without understanding the underlying risks is a recipe for disaster. Just like any investment, it's crucial to do your due diligence. Research the different types of bonds and choose investments that align with your risk tolerance and financial goals. We've all heard the adage, "They're not making any more land." Many believe real estate is a surefire investment destined to increase in value indefinitely. But the market is far from a one-way street. Remember the housing crisis of 2008? Real estate prices can go down, sometimes dramatically. The market operates in cycles of boom and bust. Now, this isn't to say that real estate is a bad investment. In fact, it can be a fantastic way to build wealth over the long term. But it's crucial to approach real estate investing with a healthy dose of realism and a thorough understanding of the associated risks. One of the biggest mistakes investors make is assuming that past performance guarantees future results. Just because a particular neighborhood has seen double-digit price appreciation in recent years, doesn't mean that trend will continue indefinitely. It's also important to remember that real estate is not a liquid asset. Unlike stocks, which you can buy and sell with a few clicks, selling a property takes time, effort, and often significant transaction costs. So before you pour your hard-earned money into that rental property or flip that fixer-upper, make sure you've done your homework. Research the local market, understand the cyclical nature of real estate, and be prepared for the possibility that prices might not always go up. Gold. It's shiny, it's tangible, and it's been a store of value for centuries. But gold can be incredibly volatile. Remember 2011? Gold peaked at nearly $1,900 an ounce. By 2015, it plummeted to around $1,100. Diversification is key. Don't put all your eggs in one basket, even if it's gold. Now, I'm not saying gold is a bad investment. It can be a valuable part of a diversified portfolio, but it's crucial to understand how it behaves. Gold tends to do well when there's a lot of uncertainty in the market. Think about times of geopolitical turmoil, high inflation, or a weakening dollar. These situations can drive up the demand for gold as investors seek a safe haven. But when the economy is booming, and investors are feeling confident, gold tends to take a back seat. Think of it like this. Would you rather own a shiny piece of metal or a piece of a company that's growing and generating profits? In a strong economy, most investors would choose the latter. This means that during periods of economic growth, you might see your gold investments lagging behind other asset classes like stocks. The bottom line is, gold isn't a guaranteed safe haven. It's an investment like any other, with its own set of risks and potential rewards. Don't buy into the hype without doing your research. You don't need to be a financial whiz to invest successfully. Educate yourself with the wealth of information available. Books, podcasts, websites, and YouTube channels can help. Learn, develop a strategy, and invest consistently. 。 Look, I get it. The world of investing can seem intimidating, especially when you're bombarded with financial jargon and complex strategies. But the truth is, you don't need to be an expert to start investing. You know yourself and your financial goals better than anyone else. You're the best person to make decisions about your money. Don't let the fear of the unknown hold you back from growing your wealth. Start by setting small, achievable goals. Maybe it's investing a certain amount each month or building up an emergency fund. As you gain more knowledge and experience, you can gradually increase your investments and explore different investment options. The key is to start somewhere. The sooner you begin, the sooner you'll start benefiting from the power of compound growth. Remember, time is your greatest asset when it comes to investing. So, don't wait for the perfect time or until you feel like an expert. Start today and never stop learning. Now let's talk about active versus passive investing, specifically when it comes to mutual funds. You see, actively managed funds are run by professional portfolio managers who hand-pick stocks and bonds trying to beat the market. Sounds pretty tempting, right? Having an expert pick winners for you while you sit back and watch your money grow? The catch? These actively managed funds often come with hefty fees. After all, you're paying for those expert stock pickers and their fancy algorithms. And here's the kicker, guys, those high fees don't always translate into better returns. In fact, most actively managed funds struggle to outperform their benchmark index funds over the long term. Index funds, on the other hand, passively track a specific market index like the S&P 500. They're designed to match the market's performance, not beat it. And because they require less active management, they come with significantly lower fees. Now, you might be thinking, but Graham, I want to beat the market, not just match it. Beating the market is tough, even for pros. Most actively managed funds fail to outperform their benchmarks. Index funds, with lower fees and diversification, offer solid returns. They take the emotion out of investing. No need to worry about fund managers' bad calls. Simplicity and low costs often win the race. Index funds are a smart long-term investment. You've probably heard the phrase buy and hold a million times in the investing world. And hey, it sounds pretty appealing, right? Just invest your money and forget about it for a few decades. While this long-term approach can be great for things like retirement accounts, it's not a one-size-fits-all solution. The reality is, life throws curveballs. You might need to access your investments sooner than expected for unexpected expenses like medical bills, a down payment on a house, or even starting your own business. Locking yourself into a rigid long-term strategy might mean missing out on opportunities or facing penalties for early withdrawals. Remember, flexibility is key in investing. While keeping your money invested for the long haul can yield great returns, it's crucial to have a plan that can adapt to your evolving financial needs and goals. Don't be afraid to adjust your strategy as your life changes. Think of it like this. Having a long-term mindset is like mapping out your route for a cross-country road trip. You've got your destination in mind, and you've planned out the major highways you'll take. But what happens when you encounter unexpected detours or discover exciting attractions? That's where adaptability comes in. Be open to adjusting your investment strategy as needed. Remember, you're in the driver's seat. Now let's talk about financial advisors. They can be valuable allies in your financial journey, offering guidance, expertise, and a helping hand in navigating the complexities of the market. But it's crucial to remember that not all financial advisors are created equal, and their interests might not always align perfectly with yours. One of the biggest misconceptions is that all financial advisors are legally obligated to act as fiduciaries. This means they're legally bound to prioritize your financial well-being above their own. However, not all advisors operate under this fiduciary standard. Some might be held to a lower standard, meaning they only need to ensure their recommendations are suitable for you, even if they're not necessarily the best possible option. This distinction is huge. A suitable investment might still earn them a hefty commission, even if a different choice could have yielded better returns for you. Always ask your potential advisor directly if they operate under a fiduciary duty. Their answer will speak volumes about their priorities. How your financial advisor gets paid is crucial. Do they charge a flat fee or earn commissions? This can reveal potential conflicts of interest. Fee-only advisors have no incentive to push products. Transparency is key. Ask about their compensation. Your financial future is worth it. So there you have it, guys. We've debunked some of the biggest investment myths out there. Remember, investing doesn't have to be scary or overwhelming. By educating yourselves, being wary of these common misconceptions, and taking control of your financial future, you can make smart decisions and grow your wealth over time. Thanks for watching. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell for more insightful content. See you next time.